Hello everybody, welcome back to the crypto realm. So we're going to talk about two things here, the next wave of institutional digital adoption and one large cap altcoin set to take off. What do you think it is? One large cap altcoin set to break away from the bearish crypto markets, according to top analysts. A popular analyst believes that one large cap altcoin is gearing up to break away from the downtrending crypto markets. The pseudonymous analyst Rect tells his 330,000 Twitter followers that peer-to-peer payments network Litecoin may have already printed a bear market bottom. Nice to see. According to Rect, historical price actions indicate that Litecoin has a tendency to go on a strong upswing before the coin's halving event. LTC is slated to undergo its next halving event in the third quarter of 2023. Oh yeah. Here's a little chart here showing what happens every few years. Should history repeat itself, the crypto strategist says that Litecoin could break free from the overall bearish state of the crypto markets and rally on its own. It's possible LTC could enjoy a period of decorrelation from the general crypto market over the coming months because of its upcoming Litecoin halving in August 2023. Oh yeah. So Litecoin, they could be an upswing for that. And what else are they talking about? The next wave of institutional digital asset adoption. Once you build decentralized access control, the decentralized world of Web3 and the traditional world of finance can finally be brought together. There's a lot of permissionable DeFi coming out, and institutions are jumping on board. And the DeFi numbers as of late are going higher rather than lower. So this is good news for DeFi. This is where it's all at. Skeptics are taking a cheap shot at framing the FTX debacle as the end of crypto's mainstream appeal and adoption. Nothing could be further from the truth. If anything, it's a clear sign that in 2023 and beyond, we will see more reliance on decentralized infrastructure and better regulation for centralized finance. It's also a call for better digital asset solutions in general. As many have pointed out, this was a failure in CeFi, not DeFi. A simple look at DeFi Llama shows that decentralized exchange DEX volumes are up by almost 70% despite market sentiment. So on the one hand, there is a portion of the market that is doubling down on crypto's decentralization ethos. But there's also a way in which crypto's influence will continue to grow in traditional finance despite the controversy. A 2022 survey by The Economist found that 85% of investors agree there is a need for open source digital currencies as a diversifier in a portfolio or treasury account. However, the same survey found that a lack of regulation was the most cited barrier to digital asset adoption among institutional investors and corporate treasuries. In 2023, a side effect of the FTX and Alameda Research debacle will be a shift towards more traditional regulated entities as the entry points into digital asset markets. This will be especially true for users who still prefer to use more straightforward and familiar service providers over CeFi. Why go with middling services? Go fully DeFi or fully traditional. After the market recalibrates and regulations catch up, these are the firms that will be primed to meet the rising demand for digital assets among institutions, family offices, and even many retail customers. It's easier to imagine a family office going to a regulated and reputable firm like Fidelity for diversification into crypto rather than directly into Uniswap or some new CeFi contender that may or may not operate similarly to FTX. All right, so now the important question is, are these firms ready for this? The truth is that there are some significant challenges they face at the moment. Although federally chartered banks in the US have a green light for crypto since 2020, most firms have shied away from offering digital assets products other than some exposure to BTC or ETH in limited capacities. Yeah, they let you buy like the price of it, but not the actual coin. Custody and regulations. The first challenge they face comes from responsibilities that are created by taking custody of digital assets. There are potential liabilities that firms have to take into consideration when offering crypto due to risk management policies and consumer protection laws. There's also added complexity in the fact that different regulations might have to be taken into account for different digital assets. While the global regulatory landscape continues to evolve, when a firm maintains custody of an asset, some of these questions fall under its responsibility. For example, determining whether a particular asset is considered a security or a commodity and how it may be treated differently in other jurisdictions becomes relevant to how it needs to be managed by the firm. Infrastructure. Then there are a number of infrastructure problems that need to be solved before firms can expand their product offerings into digital asset markets effectively. At the root of them is the fact that crypto is an incredibly fragmented space with assets being managed in different blockchain networks and has minimal crossover with current financial market structures, as found in the aforementioned survey by the economist. A firm looking to offer digital asset products has a hard time building products that can count on a consolidated view of the crypto space. They would have to set up and run dedicated systems for each blockchain network and all the different crypto or tokenized assets that run on them. In fact, crypto on-ramp services often have entire teams dedicated to addressing the compliance and technical development issues of adding new assets to their offering. It's easy to see how solving these complex problems on their own is not a priority for traditional finance firms despite the growing demand for digital assets. All of these challenges point to a broader problem that can be summarized as follows. Crypto and Web3 infrastructure are evolving quickly, but still ignore rules-based access control as the main starting point. Okay. All right, so this is a pretty long article. You guys can finish it off. I just got you started, I guess. So the next wave of institutional digital asset adoption. So they're looking for permissionable DeFi. And that's going to be places like Coinbase are going to be doing that. Aave has already started doing that. That's going to be your permissionable DeFi. Compound Curve, those kind of places. So that's where institutions are going to be able to go, do their DeFi business, get in, get out. That's coming very soon. The regulations are going to make that all clear. And when that happens, institutions are just going to dive right in. All right, so the crypto realm. Play hard, trade smart.